Welcome to the latest episode of The Financial Frontier. I'm your host, Patrick Camuso. Today, I'm very excited to introduce our guest, Andrew Gordon. Andrew is a Andrew is a tax attorney and a leading crypto tax specialist. So today, we're going to discuss his perspective and his experiences working with investors at his legal practice, and hopefully, he'll have some good tips and insights related to crypto taxes. Andrew, thanks for joining us here today.
Thank you very much for having me. I'm looking forward to the discussion.
Absolutely, absolutely. So to get started, can you tell us a little about yourself and your company and how you got involved in crypto and Web3?
Sure. So again, my name is Andrew Gordon. I'm an attorney, also a CPA. I got my CPA before I got my bar degree. I would
Very
say
nice.
the CPA exam is more difficult. So well done, Patrick. My practice, we mainly focus on crypto. We've been doing crypto since 2014. So I'd say we're one of the first in the industry. And what makes us a bit different is that our largest part is tax compliance. We help clients report crypto on their tax returns. But uniquely, we also help clients with audits, criminal investigations, general IRS issues and disputes. So we're fortunate enough or unfortunate enough that we get to see what goes wrong, and we're able to often use that insight to help our clients with compliance with tax reporting.
Definitely. I think that's very interesting. So based off of that, what are some of the biggest mistakes that you see investors make when it comes to crypto taxes and accounting over the years?
Sure. So still in 2024, I get calls almost every single day from people that don't know or say they don't know that they need to report crypto unless they've cashed out. They think if I cash out, then I need to report. Cash out being converting to cash or fiat, but otherwise don't need to report on your taxes. But that's unfortunately just not true. As hopefully everyone that's listening is aware, if in crypto you have to report on your taxes for every transaction, every time you exchange, convert, swap. Any disposition generally has to be reported, not just when you cash out. So although that seems obvious to many people, there are still a lot of people out there that just don't know that.
Exactly. I'm in that same boat as you. These obvious things that I feel like we've been preaching for years and years, there's still just a lack of understanding industry wide, especially when there's new people that are entering into these new cycles. So what are some practical tips that you can share with investors when it comes to managing their accounting? And one thing I want to mention just related to the cash outs is that this can really, and I want to hear if you agree with this, I've seen this really hurt people in prior cycles where they're thinking they just have to claim taxes on their cash outs, and maybe they're doing exchanges between different altcoins, and they're generating profits as the price is appreciating, and then they'll maybe come to us during tax season when a bear market has happened and realize they're on the hook for taxes with all these transactions. Have you seen that, and have you seen that really negatively impact someone's bottom line?
Absolutely. So we've been in the industry again for a little over 10 years. And over those 10 years, there have been ups and downs in those cycles. And they're one of the downsides of the ways capital losses work are that they can be carried forward, but they can't be carried back. So timing is very important. And what we often see in boom and bust cycles is that perhaps you might have gains one year, losses another, but you can't bring those losses back. And so from a tax planning standpoint, it's a great tip or piece of advice. Right now, we're in the middle of 2024. A lot of people are experiencing gains. But if the market goes down, a lot of people tend to hold during that period too and may not take those losses. And if you don't take those losses in the same year or before and carry it forward, then you're going to have gains. And you might then owe tax even after the value has decreased. So it's very important to know, even as the year goes on, what your what your tax filing gains are going to be. And if the market does correct, and we're all hoping that it's going to go to the moon and, big numbers by the end of the year. But if it does correct, that you have a plan in place and know how you're going to try to offset those early year gains, because otherwise as I mentioned, you might just have a tax bill at the end of the year.
Exactly. And because you've seen multiple market cycles, I'm sure you maybe have seen this issue as well, where people are trading altcoins, they're booking capital gains maybe into Ethereum or into another large cap, and they're not very inclined to sell that when we're in this euphoria of a bull market and the price is only going up. But then inevitably, and I believe this time that we'll have this inevitably as well, we're going to see another bear market and then taxes come due. So have you ever seen investors, they're booking these gains and they're planning to pay their taxes out of the gains that they've made in their portfolio, and they're holding that in a volatile crypto asset, and then it takes maybe a 50% price cut?
Yeah, absolutely, absolutely, and we see that all the time too, which is what you described, where you've got paper gains, but no cash, right? First thing I talked about is how you can be taxed on exchanges dispositions without cash occurring. So we see that especially in appreciating markets where people are actively trading, that there are realized or tax gains, but no cash necessarily to pay those gains. And the issue is what you've discussed. When taxes are due the next year, the IRS doesn't care if your value has decreased. You still owe your tax based on those gains, those paper gains of the year before. So a tax strategy we often discuss with our clients is calculating estimates of taxes due on gains, either periodically or on each transaction or set of transactions, to determine what your tax is at that point. And then perhaps selling a certain portion for cash or fiat or stable token, putting it aside in order to pay those taxes. Now, of course, there's still the opportunity to harvest losses and do things like that by the end of the year, but opportunities come and go. And with a appreciating market, in fact, sometimes there may not be opportunities to harvest losses. So it's important to know what your tax due is throughout the year.
Exactly. I think that's the key. You hit the nail on the head is, regularly doing tax projections to understand what your tax liabilities are, so you just don't expose yourself to that validity risk as far as your tax payments go. So based off of, your experiences managing this accounting and tax function for investors, and then I know you're also on the audit side as well, can you speak to a little bit about like the key challenges that investors are facing when it comes to audit readiness that are unique to crypto compared to more, traditional investment types?
Yeah. As crypto investors or traders, we are at a disadvantage from a tax reporting perspective. All other trading, investing, stocks, securities through brokers are reported on very easy forms for you to enter into TurboTax or to give to your tax preparer. And you don't need to be crunching numbers to figure out your gains, losses, or different income on different types of transactions. It's all reported to you in these types of trading. But with crypto, it's just not the case, at least not yet. And I know we'll talk a little bit about 1099 DA forms that are set to be issued. But right now, the requirement is on the taxpayer to obtain, organize, and report all those crypto transactions. And while that may seem simple, the people we typically talk to have several exchanges, several wallets, several years of data, and it's not necessarily easy to trace it all, determine the gains or losses, remember when a withdrawal was a gift to your friend or a transfer to your own wallet or a payment for services, right? It's very hard to remember often these things as well. Yet each of these have different taxable implications that we need to be aware of. And again, the requirement is on taxpayer, not the exchange or the wallet, at least yet, to send that information. So it's often very difficult for individuals to report their crypto because they need to use either software, which we can talk about some of the issues that software have out there, or work with a professional like Patrick or myself to prepare their crypto taxes.
Exactly. And I'm sure, you see this a lot as well as myself, where maybe people are realizing that they have this self-reporting requirement that is unique to crypto. And then, like you said, they maybe are going to go and look at all these software solutions that are out there. first of all, they're going to have to figure out, which is going to be the best one for themselves. And then they're going to have to deal with actually accurately categorizing and reconciling the data with full accuracy and due diligence. And there's many challenges to that. So can you, I think there's a misperception a lot of times, especially with investors that are just sort of wrapping their head around this, that you could just pop your wallet addresses and your exchange API keys into one of these softwares and you're just going to get a tax report that's accurate. And you and me both know that that's not the case. So can you speak to a little bit about that, the data issues, and, some of the due diligence requirements?
Sure. And nowadays there are many different crypto tax software programs out there. And if you're on social media or on the internet and you're involved in crypto, you're likely getting targeted by one of them for ads.
Or many of them.
Or many of them.
Yeah.
And while they may all seem to be a one-stop solution to getting your crypto done, crypto taxes are incredibly complex. There are many, many rules involved, but unfortunately, the software doesn't answer most of those. It provides the optionality or the questions for the user to answer, such as, was this transfer a gift, a spend? Was this deposit income to you? Was it a transfer from another wallet that we don't have the records from? And so the software is at best as good as the inputs and the user activity, the user help that goes with it. But that's two crucial parts. One, the data, and two, that the taxpayers, the users, customers actually spend the time going through it. And the first part, the data, is often a big issue. Most people that we speak to don't have complete data. They've forgotten wallets over the years. They don't have access to an exchange that's closed down. They don't have their login information, whatever it may be. But if you don't have complete data, then the software is not going to be able to match all of the ins and outs properly and figure out cost basis for potentially even all of your sales, which is another issue we see very commonly in software, which is that it shows sales in excess of purchases, and therefore it gives you zero cost basis. And we hope that that's impossible, right? There's no double spend going on with cryptocurrency, right? No one's hacked the blockchain that I know of, at least none of my clients have that I know of. So they're not spending more than they bought, right? It's impossible, which means that we don't have the data for the initial purchase or exchange into that token. Or there's a deposit coming in that really was a purchase or income. There's all of these variables, and I can go on and on for hours and days about all the different options and ways that the software could have issues. But at the end of the day, if you're a user and you've got hundreds of transactions, thousands of transactions, you've got more than a couple exchanges or wallets, it's going to take you hours of your own time or hours of professional time to go through all of that, make sure it's accurate. And if you don't, what we typically see is material differences. It's not just, I did my best. And that's actually something I hear perhaps every day from people that call in.
Yes.
I reported doing my best. And I applaud you, pat you on the back. At least you did better than the people that didn't report at all. But it really will come down to how different is that from what should have been reported. And in many cases, those differences are material, not just in dollar amount, but in the transactions that are being reported. Going back to where we began, you have to report every single transaction to the IRS. And so if you reported one line item and it showed me $10,000 of gains, and you say, okay, that's about right. But the reality is you had 1,000 transactions that added up to $1 million of proceeds. You're asking for an issue with the IRS because you haven't provided all that detail. You haven't closed the loop of data to the IRS.
Absolutely. I completely agree. The data issues, unless you're just, like you said, maybe on like Coinbase, one centralized exchange, you may be able to plug that in and get a good data set. But once you start adding non-custodial wallets, various blockchains, various protocols and assets that you may be investing in, the complexity quickly increases, and then you're going to start to see all types of data quality issues that you're going to have to identify and appropriately adjust with the good due diligence process. And then on top of that, even if you get good data, like you were saying, you're going to have the tax questions that arise based off of your investment activity. So that's really where a firm like yours comes into play, is helping people navigate both of these issues. And another thing that I'll add, because you were talking about some of the due diligence issues, and there's, a lot of times I think people will come to us and they think that they've cleared out some of these due diligence issues. Maybe they've matched up all of their cost basis data. One thing that I'm seeing that I'm interested to hear if you're seeing too is that even if they get the cost basis data match, sometimes there can still be discrepancies that they're overlooking that are going to hurt them in future years, and it's because they're not accurately tying their ending cost basis, meaning they're not taking their calculated ending cost basis and comparing it to their actual. And that is one of the final checks to really make sure that, there's not transactions floating around out there that you potentially missed.
Right. I think what you're talking about is the volume of your portfolio, how many units you're actually holding at the end of the year of each specific crypto token.
Yes.
And I talk to people all the time on consultations. They say my portfolio is worth 100K. I know I've got 5 Bitcoin and 3 Ethereum, and it's worth this. Fantastic. But from a tax perspective, and also the software, because it's essentially a calculator, has a calculation of what it thinks you're holding at the end of the year, or most of these softwares do. And so if the software thinks you're holding 10 Bitcoin and you're really holding 15, well, once you sell through those 10, Patrick, to your point, you're going to be in a world of hurt, because you now either have zero cost basis, or you're going to end up going back years, going back through the data, amending the returns to figure out what actually was incorrect.
And that's why the due diligence is so important, because even if you think maybe you cleared out some of these initial checks and maybe you've matched your cost basis, you still can have a completely inaccurate calculation, and these are going to impact you for multiple years. Now, that is another interesting point that I sort of want to hear your perspective on and what you're seeing at your practice. Are you seeing, like, every week or every day, are you talking to people where maybe you're still going back and doing their accounting from like the 2016, 2017 timeframe and rolling them forward? That is a big issue we see. So I'm interested to hear if you see that, and maybe if you can speak a little bit to the cumulative nature of tracking this cost basis data.
Sure. So yes, we're seeing the same thing, which is more clients than not are requiring new clients are requiring us to go back several years, typically to the beginning of their activity, and generate the tax reports for each year forward. And the reason for that, which you alluded to, Patrick, is that you can't just start with 23 or 24 unless you weren't holding anything at the beginning of the year.
Exactly.
Which I haven't had that call. But it's possible, but I haven't had that call. So and the reason for that is because whatever you're holding, we need to know the cost basis, what you purchased it for, and the date of acquisition for each unit, for each lot that you acquired over time. And so while you may again know your portfolio value, or that you hold 5 Bitcoin, unless you can identify, I have 5 Bitcoin, but I bought one of those at $10,000 5 years ago on this specific date and time, one of them at this value at this date and time, then we'll need to go back and actually calculate that. And often too, what we find is that people we speak to haven't reported properly in prior years.
Yes.
And unfortunately, most of the consultations I do are for people that are trying to be proactive and report crypto on their taxes. A large part, and starting to get to almost about half of the calls, are people that are getting IRS notices, bills essentially, or getting flagged for audit, or getting exam notices. And that's very unfortunate. In a lot of these situations, it could have been avoided simply by reporting. Most of these, if not all of these exams or notices, are people that haven't reported at all, or have substantially not reported. Maybe they reported, their Coinbase account, but not everything else. So these are very avoidable had you reported as thoroughly as possible. What we're seeing on the other hand is those that are reporting thoroughly. And over the years, we've helped well over 1,000 individuals report prior years crypto on their taxes, that the IRS is generally leaving them alone. statistically, our clients that are reporting are at less chance for audit than the national average is. On the other hand, those that are not reporting, I would say if you're listening to this and you haven't reported or only reported some, there's a high risk of audit, and it seems to be growing as the IRS is stepping up enforcement efforts and hiring more agents and so forth.
Yeah, the IRS is definitely stepping up enforcement efforts, and you can tell just by, some of the information that they've published that there's definitely a focus overall with them on cryptocurrency. I mean, you can go to the IRS's website right now and they'll be citing a 75% non-compliance rate based off of the transaction data that they've collected over the years through various means. So the non-reporting, I think, is the lowest hanging fruit for the IRS, and it seems like that aligns with the experiences at your practice as well. But I'm interested to hear more on your perspective on, obviously non-filers, and then are there any other areas that you see big focus areas for the IRS when it comes to auditing crypto investors?
Yeah, so if you didn't report crypto, that's the largest red flag, right? You had crypto, you didn't report it. Other thing to be aware of, IRS has had a crypto question on tax returns, on individual tax returns. I believe since 2019 on Schedule 1, Schedule 1. Now front and center after name and address on page 1 of the 1040. It's been there for a few years now. It's a yes or no question. We haven't seen it happen yet, but what I anticipate to happen is that the IRS is going to use this yes or no question to prove willfulness for fraud. So if you have checked the box no, and you've had crypto trading, certainly want to think about filing an amendment, checking it yes, reporting the trading. Also, check the box yes, but didn't report the crypto. Come across that too sometimes. People saying, well, I want to at least let them know.
What are they thinking there?
Report. So not a great idea either. One of the most common though, other than not reporting, is I reported some. I took the Coinbase tax report. That's probably the most common misconceptions. The Coinbase tax report, unless you're just trading on Coinbase, that report is near worthless. I'm sorry to all the Coinbase executives that are listening, but that tax report is very misleading. A lot of people think, oh, this is what I can use. I can plug this into TurboTax. It synchronizes with TurboTax. Awesome, I'm done. Unless Coinbase was your only exchange, it's not going to have all the data from the other exchanges. Also not going to have cost basis for anything that came into Coinbase through transfer. And our clients, people we typically talk to, have several exchanges, several wallets, and Coinbase is not aggregating that data. It does not have all that information. And just because those exchanges aren't providing you a tax report doesn't mean you can ignore it. So if you've reported some from the Coinbase report or just done your best and used some data in a tax tool, in a crypto tax tool, also big audit red flag. The IRS is getting a lot of data and information from many exchanges, including exchanges that people thought IRS would never be able to touch. There's a lot of speculation, even Binance, CZ entering into an agreement with the Department of Justice, including an information sharing agreement, right? Who would have thought, right?
Yeah.
So IRS, though, is getting a lot of information through bankruptcies, through agreements, through
the J5 agreement, the international one. So even when this stuff is happening in other countries, they can get some of that data as well.
Yeah. So they've got a lot of information, and their computers are comparing the information that they have with what's reported. So if you have all of these other exchanges, all these data sources, they've only reported part. It's fairly easy for the IRS to know that just based on their information. And then once they take a slightly deeper look, once they get, for instance, just the Coinbase data, then they'll see withdrawals, transfers to other exchanges. The proof is in the chain.
Exactly. Once you start doing the crypto accounting, you can't just pick and choose which data sources you want to plug into it. Then they're going to be able to see these data gaps, see the outgoing transfers, and put together that there's more to this picture that they need to address. So You've been in this space since 2014, which you're probably one of the earliest guys in this space. I've been in this space since 2016. I'm interested to hear your perspective on if you've seen a shift in like perspective and sentiment just from like the industry in general, on Twitter, just people that you're speaking to in your practice regarding just tax compliance in general. Because, back in the early days, I would say like definitely through 2017, people definitely did not want to hear anything about cryptocurrencies. And has that shifted from your perspective, and like to what degree?
Yeah, yeah. I used to hear all the time, it's a gray area, right? No one really knows if you need to report. These things are all gray. Seems to be less of that. And keep in mind, the first IRS guidance on crypto came out in 2014, identifying crypto as property rather than a currency. More substantial guidance actually came out much later. Right? There's kind of a big gap in a lot of guidance. 2019 IRS releases FAQs, and I think the FAQs perhaps answer a lot more questions than a lot of the guidance that's even come out since. That wasn't that long ago. And then since then, they've issued some other memos and rulings as well. But there has not been a whole lot of information, and the information fairly recent, right? And so over the years, though, fewer people are, I would say, don't think that crypto needs to be reported at all. They're understanding that it does, and that there are rules, there is guidance out there. Some things are gray, right? There are still situations that we come across every day that our attorneys talk through with our accountants, because there is no clear answer. But the typical types of transactions have been answered and are taxable. So I would say that's kind of the big change, is that people are much more aware. And maybe it's in part that the IRS even put a question about crypto on the tax returns, right? And put it right in front of your face that, hey, it's taxable. There are tax rules here. So I'd say that's probably the biggest shift.
Definitely, I agree. I've seen it go a long way from just people arguing about whether they have to report or whether they can do like-kind exchanges to now, they're coming with a higher level of awareness, but they're still dealing with, like you said, all the complexity that's associated with this industry. And it seems like each cycle, the complexity continues to grow as we start to see, new protocols, new asset classes, new blockchains. So it doesn't seem like the complexity is going to slow down. Likely, it's only going to increase. So obviously, one big thing that's top of mind right now for all tax professionals in this space is Form 1099 DA and, the proposed broker regulations as well, which I think, were released back last August during the summer. So I'm sure you've gotten a chance to at least do a preliminary review of that form. I'm just interested to hear what are some of your thoughts on the form and just the proposed broker regulations in general.
Yeah, so the proposed broker regulations in a nutshell, for those of you out there listening, seeks to apply to crypto much of the same broker rules that I had mentioned in the beginning that apply to stock and securities brokers. For example, Robinhood, if you're trading trading stocks on Robinhood, they're going to issue you a 1099B form that has, in most cases, all the information you need to file your taxes. You can plug it in your TurboTax and be done. Crypto doesn't exist yet. So the broker regulations sought to expand the definition of brokers to also include certain crypto intermediaries and brokers. But the definition of those has been hotly debated because crypto, much different than the conventional brokers or exchanges, things like Robinhood. Crypto, there are decentralized wallets. There are decentralized exchanges. There are unhosted wallets. There are all different protocols that are coming out every day, which have the technology to convert or change one token to another. And so how expansive is the definition of broker? Is it just exchanges like Coinbase or Kraken, or is it inclusive of your unhosted wallet, your hardware wallet that can also tie into a decentralized exchange? And then who's going to report there? So those are some of the issues that we're regarding the broker regulations. And so the 1099 DA form, a draft has recently been issued, which anticipates a lot of the requirements of the broker regulations being approved, and now creates a form so that this information can actually be provided to the IRS and to taxpayers. The form in many ways looks like a 1099B, includes a lot of the same information, date acquired, date sold, cost of acquisition, sales price, right? And that's key information. Long-term, short-term, was it covered or non-covered? And that's a language from the typical securities 1099B, meaning was the cost basis information provided on the form and to the broker? So a lot of those things look just like a 1099B, but then there are some things that are a bit different. There are check boxes for the type of broker, which include essentially Bitcoin ATMs, as well as, and drum roll please, unhosted wallets. And so, at least by the draft, the thought is that the expectation is unhosted wallets will also need to comply with the broker rules. And there's been a lot of pushback on that. And so how exactly will that work? And even things like how will this data be transmitted from one broker to another is yet to be determined. And so for this form to work well, you need to have the cost basis information, right? That's how the form is useful. If it's just the proceeds, the sales price, well, thank you, but no thank you. That doesn't do anything. So you need the full picture. You need the cost basis as well. But most all of the people we talk to have more than one exchange, are transferring crypto from one place to another. So will that data be transmitted? How will it be? When will it be? The form also seems to anticipate that in the first year, a lot of this information won't be collected on cost basis or transmitted. And so, at least in the beginning, may not be cost basis on this. So I think that'll be a big issue. But yeah, those were kind of some of my thoughts. What were your thoughts?
Yeah, I agree with you. I think, the cost basis, sharing the cost basis information, I'm really interested to see how that's going to actually play out and if we're going to actually get accurate statements once that information starts getting reported. And obviously industry wide, it's a point of contention that they're including the hosted wallets. Basically anyone that's going to be affecting a transfer of crypto assets is going to have this reporting requirement placed on them. So that's just placing a big burden industry wide on people. I've seen a lot of people say, this could even lead to geogating US taxpayers out of certain, protocols and websites that they don't want to comply with this. So from my understanding, this draft form of the 1099 DA is not reflecting any of the comments from the comment period from the proposed broker regulations, which, a lot of those comments, the point of contention was them including the unhosted wallets. So I'm interested to see what the end form of this is, if they're going to keep that as a sticking point or if there's going to be, some point of negotiation there. It's hard to see. I understand from, the IRS's perspective, they want to obviously collect this information to get people to be compliant. But I guess my concerns are the level of data collection that it's extending to all unhosted providers. When I was first, anticipating this, I kind of was expecting it to be focused more on centralized exchanges, at least at first. I was surprised that they went, wholly for unhosted wallets in this first attempt with these proposed broker regulations. So I'm interested in those as well as just the quality of reporting that we get from the 1099 DA, because there are other, tax reporting sometimes that people will get from certain exchanges. And oftentimes right now we're seeing those be inaccurate. I'm sure you are as well, for the same reason, we're sharing the cost information. So this form should, help pass that information along between all of these parties. But it's just about, is it going to be accurate, especially when you're including such a wide category of people that are going to be reporting on this form. Basically anyone that's a hosted wallet provider is going to have to be accurately tracking cost basis information and passing it along. So we're going to have to see, where that goes and how it affects taxpayers in terms of their ability to, use these protocols in the US and then accurately report them? And when they get these 1099 DAs, are they going to be accurate, or is it just going to be another tax form that we're reconciling against our own accounting, basically?
Right. Yeah.
So obviously, like, this industry that we have found ourselves as early adopters of is only going to continue to grow from here. We're going to be in a nice cycle now, and then we're going to have more in the future. History is going to basically rhyme and repeat. At least that's what I believe. And each cycle, I have seen like more tax professionals, CPAs, attorneys come into the space during each cycle to serve growing need. Can you speak to a little bit, if you're a CPA or a tax attorney and you're looking to get into this space, like what are going to be the challenges, the learning curve, and like how can someone approach that?
Yeah, so there's certainly a lot of opportunity in the space for crypto tax enthusiasts. As Patrick, you mentioned, the vast majority of crypto investors are not reporting on their taxes. And one potential way to even close that gap is for tax professionals to ask more often or at all about crypto trading. I'd mentioned that there's yes or no checkbox on the tax return. The startling part is that most tax softwares for professionals default to have that check no. And don't even have a critical or a forced diagnostic where you have to answer it. They'll just check it no, and you've got to go in and manually update that. And so a lot of tax professionals, although the IRS's intent was, hey, we're going to put this question there, so tax pros, you better ask, often doesn't happen. And so just as a starting point, tax people out there, ask your clients about their crypto activities. And it's not just whether or not they cashed out, it's whether they had any exchanges, sales, income items at all. But challenges to the people that are trying to get into the space, while the opportunity is massive, it's a new frontier. And there are several challenges. One, knowing the crypto, knowing how crypto works, being able to talk the talk, right? If a client comes to you and they're asking you about rebasing tokens, and you're calling your ethics attorney to find out if you got to call the cops, about his drug use, problems, right? So you have to know crypto. You got to know how it works, not only to talk about it, but also to apply the tax rules to it. While many questions have been answered, FAQs, rulings, otherwise, many have not. And so we have to apply old rules, analogize other types of circumstances to crypto. So you've got to know crypto, you've got to know tax, you've got to be able to combine the two, but also the software out there, it leaves a lot to be desired, to be candid. It's the software out there, many of them are good, some of them are better than others, but they're not perfect. And so if you're a professional and you're expecting a TurboTax-like experience where you can just throw the data in there and have reports generated and charge your clients a bunch of money, it's not going to happen. Our accountants are spending tens of hours on average working with clients through crypto transactions specifically. So it's very data intensive. It's more analogous to bookkeeping on steroids than tax preparation. So it has all of these challenges, but at the same time, opportunity.
Yeah, there's a ton of opportunity, but like you said, the challenges are significant. I mean, if you're looking to get into this space today, you're going to have to clear a very huge learning curve just to get caught up to the speed of the crypto industry now that's been growing for the past decade. And like you said, the data issues are huge. And I see sometimes people that, are new into the space and, looking to come into the space, come in and, they think maybe they can just rely on these softwares and rely on the data. And then their clients can get, very inaccurate reporting as a result of that. And sometimes we'll have those types of clients come to our firm for maybe the subsequent year. We'll look at their reporting and be able to see, there's unmatched gains or losses, there's inaccuracies in the ending cost basis data, this or that. So nothing's plug or play. You're going to have to know how to read block explorers, track and trace the transactions, and do proper due diligence on the accounting. And that's really just to get the data right, like you said. Then on top of that, you got to get the tax positions right. And to do both of those things, you need to have that fundamental understanding of accounting, and you had to stack that skill on top of your skills as a tax attorney, a CPA, or a tax professional, or an accountant. So there's definitely a learning curve, but a huge opportunity, like you said. Are there any like resources or learning strategies that you'd recommend? I know you and me basically have learned the hard way as this has went along, and have had to like really earn it. But are there any places that you would point out to people?
Yeah, so there is probably, I think it's about a handful of IRS regulations, rulings, topics specifically on crypto. The list is an afternoon of reading in order to understand what the IRS has released. And so that's a good starting point. Then, secondly, as a shameless plug, and also Patrick, in support of your channels as well, we release information on crypto topics very regularly, issue a lot of guides, blogs, topics on detailed topics related to crypto. So find some good professionals that are in the space. There aren't that many either, and follow them. Most of us want to share our knowledge and put this information out there. So follow us, follow Patrick, follow some others.
Yeah, definitely. I know, Andrew, me and you both have been putting out content for years and just helping to, educate people more. You put out a ton of great blogs on your website as well as videos on your YouTube channel. And they're, extremely educational, really no fluff, no sales pitch, really just delivering information that can help taxpayers, tax professionals just wrap their head around all of these crypto tax issues. And I think that's key, is like finding people that have been doing this for years, that are in the trenches, that have already, went through all of these intricacies and are just putting the information out there for you to consume. That really is the best point, outside of just, like you said, looking at what the IRS has given guidance on already. So, Andrew, what is the best way for our listeners to connect with you if they want to work with your firm, or even like find some of your content and just learn more about you, either personally, where can they connect with you, as well as how can they connect with your company?
Yeah, the easiest way to find us is our website, Gordon law.com. And through our website, a lot of information on our blogs, also links to all of our social channels, and our newsletter as well. We issue a newsletter that also has a lot of very helpful information. So our website, great place to start, gordonlaw.com.
Awesome, guys. So I would encourage everyone to go to gordonlaw.com, check that out, sign up for the newsletter. There's a ton of great information in there, and I'm sure you'll benefit from it. So, Andrew, I really appreciate you taking the time out of your day today. I know we're coming off of tax season here, and I know you're still probably quite busy with your firm. So I appreciate you taking the time here today. And to everyone watching, I hope you guys gain some value from this. Until next time, I'm Patrick Camuso, signing off.